This is Biashara Tuesday, and when we are seated on the lounge, it is about to get down. I promised you earlier that we are going to be talking about the finance bill, and just so you know, don't be tense where you are because it's not a day when we are about to be talking as economists here. It's a day when we are going to educate you. We are going to be telling you what is in the finance bill and how is it affecting you. And this morning, I am joined by Monica. Thank you so much for making time for us this morning. How are you doing?
I'm doing fine.
It's a very chilly morning.
Yeah, very chilly. Thank you for having me.
Always a
Glad to be
pleasure.
here.
Always a pleasure to have you on board. So, Monica, just before we get this, I would like you to give an introduction to our viewers because you will do it better than I would do it.
Right. I am actually an accountant by profession. I do a lot of finance work. And tax as well. I love tax. I do a lot of tax planning for my clients, tax consultancy, strategy, finance. So I'm glad to be here just to break down the finance bill 2025. Does it matter? Does it not? We'll know.
We'll
Yeah,
know as we
we'll
go
know.
by.
Yeah.
So for the last 1 year or so, we have had a change in the management of the treasury, and we have had Mbadi who came in, and from the opposition side of view, they say that we are bringing the minds in the treasury department, and throughout this process, Mbadi has been telling us as a country that we are not going to increase taxes, but we are going to tighten the loopholes that are in the finance in the taxation field and all that. So wale watu wenye they are evading taxes, we are tunaenda kuwashika. Those industries that are not fairly taxed, maybe probably let me say fairly taxed. We are going to increase their taxes, and those that we feel like wamefinyiliwa, we are going to give tax reliefs to them. And it's at some points it's been like an encouragement of investment in the country, because over the past year we have seen so many investors leaving the country because they say there is so much of unfavorable economic environment for them to thrive in the country. So from where you sit, do you think that Finance Bill 2025, there's a difference between Finance Bill 2025 and Finance Bill 2024? Has it gotten better or has it gotten worse?
I'd say they were cleverer this time round. Um, they've definitely tried to close the loopholes, and we can see they're trying to use e-teams for that by introducing some clauses which say that even if you're supplying exempt goods, you still have to do it through e-teams. So essentially, that closes the supply loop. So, and then introduction of other clauses like if you're supplying to government, they will withhold a certain amount of tax. So that means the government will have a clearer picture of most transactions, let's say. When it comes to investments and capital flight, that has been happening a lot. Actually, if you compare it to, say, a country like Rwanda and Uganda, they've been getting more FDI than Kenya, which is nobody wants to hear that. Like, we've always topped in that list since forever. But if we check the last 2 or 3 years, they have beaten us as much as they have oil and gas projects, but they've still beaten us. So we've seen some deliberate clauses or introductions in the Finance Bill 2025 that will help bring in the cash, which is good because government is having a lot of liquidity issues. So yeah, so I think um, also I've never seen such a short finance bill. It was very short. Normally it's pages, many pages. This time it was just 37 pages. That's quite
Direct to the
impressive.
point.
Direct to the point.
We are
That was
changing
good.
this,
Yeah.
we're changing this. Period.
Yeah, that was really good. I think that was also informed by what happened in last year, June 2024. And I think government now knows that Kenyans actually read. Kenyans are more aware, so Kenyans are going to scrutinize. So they were a bit also conservative in terms of introducing new taxes or new provisions for especially employment income or income tax for corporates, that they were conservative about because they knew that would cause an uproar. Yeah, it kind of.
Okay, you've mentioned something about the government being aware of everything that is happening in the country in terms of all transactions, introducing the e-teams and all that. So, what do you think about this proposal to have the Treasury have access to personal data, especially the impact on small enterprises, MSMEs, who majorly transact through M-Pesa and all that, trying to get them on board? How do you think this is going to affect the common mwananchi?
So first, that's a breach on the Data Protection Act, primarily. If you go by the law right now, it's a breach of the data protection. They're not supposed to access data from a third party, especially if this third party is using your data in the continuity of their business or in the provision of a service or a good to you. They're not supposed to access that data without, say, a court order or your consent. Having said that, I think this should be a matter that should really be pushed during the public participation, perhaps go to court if that becomes an option, because the moment they have that embedded in the law, and I mean the Finance Act 2025, that means they will have unlimited access to even your personal, say, M-Pesa, personal transactions. That means they can't. It's not like they're not doing it right now, but right now they cannot go all out because it's against the law. Like, honestly speaking, it's not like they do not have access right now. They do, but they cannot go all out. So if they have the permission to do that, they'll go all out. They'll analyze your personal statements. They'll say, Sylvia has this incoming, so she must be making a lot of money. Let's try and compute income tax, and then you'll just find a liability on your iTax. You try to query it, it becomes a problem. So I don't think they should find a better structured way. I think with e-teams they can achieve what they're trying to achieve because the goal is to broaden the tax base. I get the goal, which is good. Broaden the tax base, but as they do that, don't infringe on privacy rights. Yeah, data privacy is key.
Do you think this will get people into more default in terms of taxation and paying the dues? Because the current bill is trying to encourage voluntary payment of taxes. Do you think this is some way going to interfere with that vision?
So I think it will derail the advancement of the financial sector. We have one of the most developed financial sectors in the world, by the way. Like, kudos to us. So, and that's because we have taken a lot of we have really consumed it a lot, especially mobile money. So what will happen is, if I realize KRA is snooping around my mobile money or my transactions without my consent, I'll probably start doing cash transactions, which will then make the financial sector lose money. Yet the financial sector by itself is a big contributor to the tax payable to government. So it's they need to be careful because there's always action and reaction. So, okay, you're snooping, I'll avoid using bank or M-Pesa. So what happens to the providers of the services? It's deep, and then it's just
we go back to the era where we are having money in our mattresses.
Which is bad.
And it has come to, I think Kenyans are very creative because right now you can enter premises and then you're told we are not doing online transaction.
Yeah.
You see somewhere written cash only.
Yeah.
I think if this goes on, we might get into a worse situation of that.
Yeah.
It might
skyrocket, or you're just told just withdraw and then pay. Don't send directly from one device to another. You're told withdraw then pay, which is a loss. Yeah.
But now there's this proposal. Some of the goods, including the manufacturing of vaccine, the fertilizer, both locally and internationally, or exports rather. And we also have products like the manufacture of mobile phones and locally
yeah.
assembled cars and all that being moved from the zero tax to the exempt.
Yeah.
How do you think this is going to affect businesses in the country?
So essentially, actually, the finance bill has focused a lot on manufacturing, and I think manufacturing has suffered. Uh, Perhaps Kenya Association of Manufacturers in their submissions, I hope they do submit, they'll bring up some of these points. So when you move, okay, zero rated good means I can claim VAT input. So I can claim the VAT on the inputs that I use to manufacture my products. When I exempt them, it means I am absorbing all the costs since I cannot claim VAT on my inputs. What that means is if I'm absorbing all the costs, I will carry them forward to my customer, who in this case is the consumer. The case of vaccines is you and me. For the case of animal feeds, that would mean farmers. For the case of local mobile manufacturers, it would mean they will not be competitive against imports. So that will probably derail that industry. We are trying to develop local manufacturing, not kill it. So it just undermines their competitive ability. Specifically for vaccine, it would affect the health sector so much. Actually, the health sector has been touched a couple of times. First, the vaccine being exempted, and then second, equipment and to specialized hospitals. They were exempt, but now they have been standard rated, meaning that cost of equipping a hospital is now higher. That means the cost of healthcare for Kenyans will be higher in the long run. These rates are effective 1st July, so it won't take long for us to see the results of that. So if I'm an investor in a hospital, want a return on investment the sooner, as soon as possible. So I will just pass on that cost. So that means probably healthcare will be expensive. It's already hectic. It's already expensive for most. So I think it will make it worse. It will also undermine now the investment in new hospitals and something like that. Yeah.
So perhaps do you think that this move of they will be effective from July?
Yeah.
Do you think that they should be given more time to adapt, especially the investors, to adapt to the new changes?
For planning purposes, yes. There should be a transition period, a transition gap, especially if one had already committed to a project. So I hope there's a provision that says that if you had already, say, commissioned your project, you had already done your projections based on, I know these are exempt, or I know I'll get for example, the investment deduction of 100%. That is something you plan over a couple of years. So I say I'm coming to set up a factory, a hospital, and I expect to get 100% investment deduction back, to claim it back. And then somewhere in the year 2.5, when I've put up the structure and I'm putting up my machinery, suddenly there is a provision for it's been repealed. What what that does is all my forecasts, my projections are down the drain, and it's a financial loss. So there, when it comes to things that are of a capital nature, first it's good to be predictable. Do not change it year on year on year. I thought that would have been part of the tax policy for Kenyans, something that has a capital nature, like investing in hospitals, buildings, in land, something like that, manufacturing. Don't change it because that makes the business environment very unpredictable. If I have cash and I want to put in the country, in the economy, I'll probably not put it here because I know next year they might say I won't be able to claim on my inputs or something like that. So, and these are plans that you make over 5-10 years. So when you're doing for clients plans, you don't plan 6 months, you don't plan 1 year, you plan 5 years, 10 years, 15, 20. So if your plan is based on there's this investment deduction or there's this exempt supply that I'm supposed to make, and then on year 5, 7, you change it, then what happens to the business environment? Investors will be like, Kenya, you can't go that direction. Actually, that's why we've been seeing a lot more FDI investment in manufacturing, in going to other East African countries. That's what has been happening by the way.
So currently, the current bill is encouraging local home ownership in the
Yeah,
construction industry because of the deduction of interest on loans used for home construction. And over the past years, we have seen most investors in real estate shifting their focus either in the country or shifting to other investment platforms.
Yeah.
So with this, do you think it's a way of encouraging home owning? But
Yeah.
how do you think it's going to affect business as a whole? Those who are into it as business.
Actually, real estate developers, they were, as long as you're doing over 400 units residential, you had a preferential tax rate of 15%. But that has been repealed under this new. So, from a business perspective, I don't know. If I'm a real estate developer who's doing that much units, I see myself now paying more tax. But from the financial sector, if I'm providing finances, I'll see it as booming business because now an individual who is sourcing a loan to build their own house. Previously, it was just interest on mortgages that was allowable. It had a cap of 360K. But now, if I take a loan, not necessarily a mortgage, a loan, and this loan is specifically to build my house, the interest on that loan, I can use it as an allowable deduction. So that means that anybody who gets hint of this information, probably if I was in the financial sector, I would start thinking of making products for loan products, financial products for
Potential
potential come get a package for building your house or something like that, capital for building your house. So for individuals, that's a win. It will definitely promote residential growth because guys will get to build their own houses. For financial sector, that's a win. For real estate developers, that may be a loss because now I probably do not have to go to a real estate. Why should I go through the real estate? I can just
and you can get it cheaply.
I can get it cheaply and claim interest on my interests. So for real estate, it's a double blow because now they have to pay full corporate tax because the 15% has been repealed, and then guys will probably opt to go source some financing option from a financial institution for home construction and then claim interest on it. So that's a new. It's a. I don't know.
It's a win-lose.
Yeah.
But you see, at the moment, just shifting to the budget, where the finance bill is financing the budget.
Yeah.
But now there is this case when the government is saying that we are not going to be doing a lot of borrowing, external borrowing, but you're going to be doing more of internal borrowing. How do you think this competition is going to be? Because the government also wants to borrow for affordable houses. You as a person, you also want to borrow for your home. How do you think this competition is going to be, especially for those financial institutions that are offering these loans?
Well, so naturally, a financial institution will definitely take what is risk. The risk is lower. So that will mean government borrowing. There's a certain level of certainty for government borrowing. Because as an individual or as a business, there are certain risks that I may default or not pay. So what that does is it sucks the cash out of the economy. So perhaps that's why there's a disconnect between what the government is saying and what we feel on the ground. You see, when guys say vitu kwa ground is different, because the government will say GDP has grown by 4.6, inflation has gone down by, we are projecting an economic growth of this, and then you ask a business owner or an employee, and they say, I don't feel all this GDP growth, precisely because the government has access to cash, because financial institutions will give them that cash preferentially. Um, because after all, even the yields on the bonds and the bills, first they cement the income, and then secondly they're higher. Uh, and then there's the traditional risk averse model that our financial institutions use. So what I'd say is perhaps now financial institutions would come up with internal policies or internal structures of ensuring that there's a good balance between um, the money or the money that is available for loan disbursement for private borrowers, uh, just not to fully refuse. Yeah, yeah. I don't know if there is something, a law that governs that. I don't know if under the Banking Act there's a law that governs that, but their primary mandate is to earn income through interests or through interests. So they will try and maximize that. But if there is enough mileage in terms of guys going out to borrow cash, sometimes you'll find that the bank is the one reaching out to you if they find that you have a good. But,
Interesting.
yeah.
Now, this is a confusing situation, especially for Kenyans, because at one point you think, okay, now this is favoring me, but if you think, you look at it kindi, you're like, okay, hapo nimechezwa.
Yeah.
You're like, okay, the government is saying this, but this is also happening. Now, I want us to shift gears to this situation where the government is especially in the tourism sector. Tourism is believed to be, it is believed, because if you ask experts on the ground, they will tell you that this is not actually what is on the ground. Tourism is believed to be a big revenue source for the country. But if we look at how the government does its marketing and all that, in terms of hospitality, transport, and all that, the motor vehicles, and there's also something to do with taxation of these vehicles used for moving tourists around.
Yeah.
So there's that part. They're already complaining that we are not supported as a sector.
Yeah.
Because if we look at what Kenya sells for tourism is the wildlife and all that.
Yeah.
But you see, these days you can have that digital. So it's not, the older generations are the ones who are keen on going to see real lions and all that. So that is shifting. And as it shifts, most people are just curious of going to a certain destination, like coming to Kenya and having a good time, enjoying the culture and all that. But you see, there's also this introduction of the change of taxes, especially on the aviation sector. That means it's also going to be affecting the transport. Like you compare the prices of just getting in the country, and you look at it and you're like, no, this is too huge. So how do you think this shift or this taxation to the aviation sector is going to affect, especially tourism in the country?
So the introduction of the standard rate on the tourism and geothermal, they've added quite a number of industries. Even in aviation, aircraft parts, they were previously embedded in law as exempt, but now they've been changed to 16%. As much as there's a provision that says that the civil authority can exempt. Well, for me that is more of a tax procedure, because even currently it's exempt, but guys still apply for exemption of aircraft parts. So and the exemption is easier that way, because it's embedded in law. But in the new provision, because it's now at the discretion of the aviation authority to decide whether they'll exempt or not, if it is now standard rated by law. So that essentially makes business harder. For tourism, it's been hard because first they increased the park fees, park fees, sorry. Now they have standard rated the vehicles and the recreation, the building of recreation, every input that goes into the setup of recreational facilities for tourism and conferencing. The transportation and logistics for tourism and conferencing, they are now standard rated, meaning that they are now more expensive, which means that we are now not as competitive. So just somebody was telling me that you can go into the Serengeti for almost a quarter of the cost of what you would go with into the Mara. It is
It's a huge
it's a huge difference. So you would lose a lot of income from that. From the stats, they say that tourism is quite an income bringer. So then it will be counteractive to introduce things that would slow down its growth or hinder its growth. Such a, on the flip side, however, perhaps the government is a bit strained for cash. And as you can see, all these measures in manufacturing, in tourism, in health, in aviation, you can see the government trying to raise funds very much, like really hard to raise funds. So I think the pressure to raise funds is greater than the need to the what can I say it the thought of let us keep the taxes where they are to grow the industry. So the pressure is great. I can tell you for sure. The pressure to raise funds is great because of upcoming loans. Most of them are falling due between 2027 and 2030. 2030. So those 2026 to 2032, somewhere around there. So a lot of international loans, they are maturing. And we already are on the spotlight for a few delay. Credit score was dropped a couple of months ago. So so Treasury is under real pressure to raise funds to meet those obligations, to pay the loans. Even currently, for every 100 shillings of the tax you pay, 70% is going to debt repayment. Already, the 30% is recurrent expenditure. That leaves you with zero for capital growth.
And development and all.
So that amidst the most reasonable way I think the government will deal with this is to cut its costs, but it proved hard. There's no goodwill for that.
Situation where we are borrowing from this lender to pay this other.
No, we are there already.
Like we don't get deep into it because we're already there. Our budget exceeds our collections. So I don't. We don't get further into it. No. Now, as we bring this home, because our time is also moving so fast. Do you think this current bill is supporting the small and medium enterprises, especially with the new changes like relief for startups certified by National Innovation and Financial Credit Agencies, and the removal of preferential rates for local motor vehicle assemblies, and also VAT standardization on goods like inputs for affordable housing and geothermal exploration. Do you think that these are really in support of especially the small businesses in the country?
All right. So, no, actually, those are in support of big business or manufacturing. I don't know whether it's in support, more like manufacturing needs to pay more in tax. But one thing I can say is good in the finance bill is perhaps two things. The introduction of preferential tax rates to startups that are under the Nairobi International Finance Authority. So as long as you're licensed in that, you're certified by them, it's like a special economic zone of its own. You get a preferential tax rate of 15%. So as the goal of that is basically to get investors, and not local, we're talking international investors, because we're talking about figures of around 3 billion. As long as you're able to put in 3 billion into the economy, you get a preferential tax rate of 15%.